The allocation process eventually forces a choice: partner with a massive institutional manager or place capital with a smaller private firm. This decision is usually framed around scale. The assumption is that larger managers provide brand name safety and diversification, while smaller operators offer focused access and potential upside. When dealing with a $500,000 allocation, this structural difference becomes highly visible. At this tier, an investment is not a sweeping market-wide portfolio. It is a concentrated exposure to a specific strategy and a defined set of assets. The most critical question an investor can ask is not the size of the management firm, but what physical realities their capital is directly exposed to. Large institutional real estate platforms are built for one specific purpose: capital deployment efficiency. They are mandated to place billions of dollars across hundreds of stabilized properties in core markets. To move that volume of money, these funds are forced into highly competitive, highly efficient markets, where asset pricing strictly reflects broad investor demand. In these environments, properties trade at a premium. The opportunity to find undermanaged or mispriced assets is virtually non-existent. Because prices are optimized, returns rely on broad income stability. Capital is entirely fragmented across a vast portfolio. Within this structure, a $500,000 allocation represents a microscopic fraction. The investor loses all visibility into the operational costs or tenant issues of any single property. Institutional scale provides a layer of passive safety through mass diversification. But in exchange, it systematically separates the investor from operational accountability and asset-level control. Smaller private firms operate under a completely different set of structural constraints. Because they are not required to deploy billions of dollars a year, they can comfortably bypass those highly efficient, crowded markets. They target niche, operationally intensive opportunities that fall below the financial acquisition thresholds of large institutional managers. These are typically properties suffering from fragmented ownership or poor management, requiring active physical repositioning. In this tier of real estate, outcomes are not tied to passive market drift. Performance is dictated entirely by direct, on-the-ground operational decisions. This dynamic reveals the two distinct engines of real estate returns: passive market exposure versus active execution. Institutional portfolios holding stabilized assets rely almost entirely on broad market trends and macro capital flows to lift their valuations over time. Smaller firms take the opposite approach. They force value creation into the asset through deliberate physical improvements and tight, localized management. That means aggressively restructuring below-market leases, upgrading outdated facilities, and strategically curating the tenant mix to maximize the utility of the square footage. Execution-driven value is a deliberate, controllable outcome. It ties the return to specific business actions rather than the unpredictable fluctuations of the broader economy. These structural differences dictate exactly how the investor experiences risk. Large funds successfully dilute single property exposure, but doing so vastly increases the entire portfolio's vulnerability to macroeconomic downturns and interest rate shifts. Concentrating capital into fewer assets naturally increases exposure to individual outcomes, but it provides operators much greater control over those specific outcomes. Every point on this curve, from signing a lease to lowering costs, acts as a direct lever, forcing the asset's trajectory upward. Concentrating capital does not eliminate risk. It transforms it from an unpredictable macroeconomic gamble into a highly visible, manageable execution challenge. This execution model is most effective when applied to specific, highly inefficient asset classes, particularly small bay industrial properties. These assets exist in a unique structural reality. They are characterized by fragmented ownership and heavily below-market rents, yet they benefit from intense local business demand and practically zero new supply in infill markets. Because managing multiple smaller tenants is tedious and aggregating these properties is logistically difficult, massive institutional buyers largely ignore them. That exact fragmentation leaves a massive gap in the market, creating pricing inefficiencies that specialized ground-level operators are perfectly positioned to exploit. In these fragmented sectors, local market precision and active lease execution consistently outperform passive capital scale. True investment discipline rarely comes from distant institutional scale. It comes from operational proximity to the physical asset. Hanson Capital focuses entirely on this approach. The strategy relies on disciplined execution, generating durable income, and maintaining direct operational alignment within high-scarcity industrial assets.